Welcome, everybody, to the third episode of HPI's podcast, Texas Dirt, Deep in the Heart of Real Estate. This is Rich Bouchner. I help lead investor relations for HPI out of the Austin office. And today I am speaking with Richard Paddock, who is one of HPI's partners in our office leasing group. Richard is a 20-year plus veteran of HPI, so he's seen the Austin office market change dramatically over the last 2 decades and changed again since COVID. So we're going to talk about Austin overall. We're going to talk about the Austin office market, the challenges that Richard has seen and other folks in office leasing have seen since COVID, where we are currently, and where the market looks like it's going over the next 12 to 18 months. Thank you again for joining, and I hope you enjoyed this episode of HPI's podcast, Texas Dirt. Really excited to be sitting down with my colleague, Richard Paddock, who helps lead the office team here at HPI in our office, or Austin office. We're going to talk a little bit about what's happening with office here in Austin. Richard's been at this for how many years now?
22 glorious years. And lots of ups and downs in that whole time period. But,
so where are we now? Are we an up or a down?
We're a down. We're not as bad as when I started in the early 2000s with the tech bust here in Austin, and that bubble, exploded, and companies were bailing right and left, and tenants just moving out overnight and shutting their doors, and it was a pretty ugly scene. So we haven't had that sort of downturn, but it's different, but still had some of the same ramifications.
So does it kind of rhyme with the GFC?
I feel like in Austin, the GFC was really kind of more geared towards obviously the financial service sector, which, the tech sector was impacted a little bit, but, we were down for probably, if you look at the cycle, we probably came down for maybe 2 years, but came up quickly. 2010, we had a really actually pretty productive year citywide. And then by 11, we were gaining some pretty good headway, and really from 12, 13, all the way to almost 19, Austin was on a really big charge. So it was interesting, the pandemic was 20, here we are in, Q1 of 25. And, office has been down since the pandemic, literally March of 20. And we're, so we've kind of bumped along the bottom or hit the bottom or scraping it, however you want to say it, for almost, 5 years. There's been a couple blips in there, a couple positive signs in 22, 21. There were a couple capital events and some buildings sold, and people kind of thought that things were a little bit moving in the right direction. From a capital market standpoint, I think a lot of that was, more interest rate driven. And, then once all of a sudden interest rates rose, office vacancy was at all-time high. That kind of perfect storm really is what I'd say is kind of elongated this kind of downturn.
Right. So I was downtown yesterday after work running an errand, couldn't find a parking spot, and there were people walking around. What's happening downtown now? Are buildings low vacancies, but nobody's actually going to the office? Or as the big tech companies are pulling people back, are they slowly filling up again? Like what's, at foot level, foot traffic seemed, there were people out and about. Like downtown didn't feel deserted to me at 5:30 or 6.
I would say downtown actually feels pretty active and lively, right? I think even over the last probably 2 years or so, if you ever went downtown in 20 or 21, which very few people did, it was a ghost town, kind of a zombie land, and thankfully the city kind of got their arms around that. But if you look overall at the metrics, right, downtown's at 30% vacant, would make you feel like it'd be a lot less occupied, but it's still pretty active downtown. I mean, we handle a 80s vintage 400,000 square foot building, and our parking garage is, while the building's maybe 80% leased, our garage is pretty tight, and we've got some co-working in there. So it feels pretty good downtown, at least I'd say from a safety standpoint. City's done a lot better job, but I just feel like business activity feels pretty good. It feels better and more lively than a 30% vacant submarket.
Absolutely. That was my take.
Yeah.
So headline news is that the large tech guys across the country are starting to pull people back to the office. Are we seeing that here in Austin? And then are we also seeing some smaller companies starting to say, okay, you've been working from home since 2020. It's time to start coming in 3, 4, 5 days a week?
Yeah, I'd say a little bit of both. So interestingly enough, just in the last 3 weeks, we've seen over $1.2 billion of investment come into Austin companies. So a local software company just raised another $500 million. And on top of the 280 they raised in Q1 of 24, those folks are growing rapidly. They're bringing people back in the office. They've got, what I saw, 80 different spots to fill right now. So current vacancies in their office. So the companies like that are making a charge, which feels good. The big tech groups, yes. I mean, Amazon, there's an example up in the Domain where they occupy a lot of space. They actually gave back a floor in one of their buildings in kind of Q2 or so of 24, and within 60 days or 90 days, they called the landlord back and asked for that space back, right? So that feels good. But you can't overlook the fact that you still have Meta with 600,000 square feet of space on the sublease market downtown. Google in the sale building that Cousins just purchased, they're slowly marketing portions of that building for sublease while they only occupy maybe 20% of it. Google does. They're marketing another about 20-25% for sublease. The remaining space isn't on the sublease market. It's kind of sitting out there as static. So, I think there's a fingers crossed that, hey, between the Amazons, Dell made their announcement a couple weeks ago, right, bringing everyone back 5 days. So I feel like there is that push. The challenge I think we're going to continue to experience is the fact that a lot of these tech companies made these decisions, right? Everyone thinks that the 6 by Quad building is, I can't believe they would have signed a lease. Now, well, they signed that lease on a pre-lease into that building probably 4 years ago. So at that point, you were looking at tech headcount growth, year over year, 20-30% sometimes. And so people were almost defensively, if you will, or proactively taking these large blocks of space, looking at historical hire numbers and saying, hey, listen, we're going to be in 5 years when this building delivers, or 4 years, we're going to need X amount of seats. And then from there, we're going to need growth room. So between Google, Meta, even Amazon to a degree, right, they've made those kind of forward commitments. And now, whether it's because they've just slowed hiring, which is a big part of it, right? Meta obviously had a number of layoffs. Google had some layoffs over the last handful of years. So, what will it take for those groups to come back and start fully occupying their space? Don't know. But there's been some good green shoots again, and some of these investment dollars are coming into the city. And so, some of these smaller, mid-sized companies are ramping up. And those are the ones that you're seeing more actively in the in the office 4 or 5 days a week.
Got it. So you mentioned the Google building, the sale building.
Yeah.
Walk me through that transaction from an outsider's point of view, somebody who doesn't understand the Austin market. Why did that happen? Were you surprised that it happened? What does that mean for other properties downtown?
Yeah, I mean, it's definitely it was a marquee office asset sale across the country, right? You pull up any national, real estate swag, you're going to see the Google building on there because it's been one of the most kind of high profile transactions. And the fact that it was a single tenant building, it's got this beautiful iconic shape to it, right? It's right on the city water, right on Lady Bird Lake. It's beautiful, right? And the story is fantastic. And a single tenant building with Google credit is going to sell for $600 a foot, right? The interesting part of that was it was kind of, I say loosely, it was marketed for over a year, right? In the meantime,
who was the seller for folks who don't know the market?
Yeah, so it was MSD. Well, Trammell Crow was the developer. They signed a pre-lease. Again, they signed a pre-lease with Google probably, maybe even in 18 or 19 for the full 800,000 square feet. That's why, to be interestingly enough, if you're looking at what that team is looking to sublease that Google space for, they're well under market. I mean, if you look at what's delivered today or delivering right about now, Republic from Lincoln, 6 and Quad, Indeed Tower, which is about 2 years old, but those other marquee buildings, those are getting 50s net. Google's rent in their building, because it was signed so long ago, is in the mid-40s. So they arguably could be making money on any subleases. Now, they've got a lot of space to fill up, but they could charge a high, a $10 foot premium over what they're paying to do that. So it's interesting from a capital market standpoint. While, take this, go back in history to 2018, 2019, if that same building was on the market and Google was occupying that building, or they were building out 100% of the space, and there wasn't a question mark in buyers' minds as to whether or not, you're going to have Google actually in there occupying, which is what's happened most currently, that building's trading for, a sub 5 cap. I mean, at 12-year term or so with Google, like that's a marquee deal. Instead, it's 6.5, depending on how you look at the rent. They gap all their rents and everything, so it's closer to 6.5, 6.75 cap on the purchase. And Cousins, it kind of makes sense. Cousins is kind of a marquee asset owner, right? They like to have kind of the best of the best in terms of physical office assets, and this kind of checks that box. They've obviously got a big presence here in Austin, and I think they also recognize that, hey, listen, if Google does contract in 2032 or 33 or whatever, like we've got a great opportunity to still lease probably one of the best office location sites in the city.
Sure.
Yeah.
That was a cool one to see go down.
Yeah, absolutely. And a bunch of people looked at it, and we talked to a number of potential buyers, and there was, just the overall size of the deal is challenging, right? So Cousins was able to come through, pay all cash, right? And then they'll probably, either put portfolio debt or individual debt on it at some point, but, not at 7% interest rate right now. Not everyone had the ability to lump down that much cash for that size of a building and everything. So
what are you seeing with loan to value right now for marquee office? Have the banks, have they loosened up at all, or is it still?
It's tough just because there's been so few data points. That's why I think this Google sale office transaction has been kind of spread around the country because there's so few data points to put out there. And then if you look back in Austin, there's only a handful of office transactions over the last, there's probably 5, institutional quality office assets that have traded in the last 2 to 3 years, and everyone's kind of got a little bit different story as to why and what my cap rate was and what my CapEx has to be. So, I think that if you were going to go buy an 80% leased building today, I don't think you're getting any more than 50% debt on it.
No kidding.
Yeah.
Okay, so you have to raise a lot of equity.
You have to raise a lot of equity, right? And you've got to have a lot of conviction that your equity is going to go a long way. And I think we're all hoping at some point that interest rates will come back down or whatever. But leading up into 25, obviously there was this anticipation that, hey, interest rates will come down in maybe 2 or 3 different times throughout the calendar year. Obviously that's proven not to happen, and looks like that's not going to happen throughout this calendar year. And so now you kind of have to have people reset a little bit of their, financing mentality of what that looks like going forward, and what can I afford, or what can I, how much equity do I need to put into deals?
And the permanent financing in office is based on the 10-year, correct?
Yep.
Right, so that's been a challenge for everybody.
Exactly.
For construction with SOFR, it's been helpful, but for longer term stuff, that's tough.
Yeah, I think we're all hoping that there's going to be a handful more capital market transactions, just so we can again get some data points and figure out really kind of where the market is, because again there's been so few actual trades that it's tough to say what's a good deal or not. And if you talk to all these guys that have all the dry powder, which is everyone, all the talk in every asset class, no one wants to catch the proverbial falling knife. So, and I don't think in Austin we're going to continue to go down much more. I feel like we're at the bottom, maybe heading back the other way, thankfully. But at the same tune, I think that from a capital market standpoint, it's tough when you have so few data points. People are having a hard time trying to figure out really what's a good deal. Yeah,
I think you're seeing that across multiple sectors in CRE right now, right? Where's the market? Well, hard to say because it hasn't transacted.
Right.
It seems like multi is starting to move a little bit. There's been industrial, but as far as office is concerned, just not a lot of movement.
Yeah.
Let's take a step back for a second. Walk our listeners through the various submarkets for office in Austin. We've been talking about downtown, but where are the other 3 or 4 places that folks may look if they're looking to office in the greater Austin MSA? Yeah,
I'd say Austin really is broken down. Austin used to be really broken down in kind of 3 main submarkets, which was CBD, Southwest, which if you're familiar with Austin, that's really from the river, Town Lake, Lake Austin, south, right, which would be South Mopac, 360 corridor area out Southwest Parkway, and then it was Northwest. Well, as things developed and over in the early 2000s, 2010s, there was a number of developments happening far northwest. So 183 out to 620, a bunch of new product delivered out in that area. More kind of back office function, a lot of surface parked, mid 3 to 5 story type stuff. So you really have CBD, Southwest, which has continued to stay kind of that same parameters, and because there's a lot of developmental challenges with Edwards Aquifer. So the Southwest submarket really doesn't have the opportunity to grow nearly as much as whether the east or the north or north central. So really CBD, southwest, northwest, you could say far northwest, which is a kind of a category that puts you out further off in that 183, 620 direction. And then there's been this with the evolution of the domain, which is, some people think it's somewhat recent. It's been going on for 15 years with retail and everything else.
Right.
But with the evolution of the domain, now there's kind of this north central, right? Which is, do I put my domain buildings in the same northwest category as something that's going to be further out on 183? And then there's the east submarket. So east submarket for downtown really means just east of I-35, which are a major north-south thoroughfare through the city. And it really is from Cesar Chavez, which essentially would be 1st Street up to 6th or 7th Street. So it's kind of a small geographic north-south area, and then it expands east from I-35 off into that direction. And that sub-market, interestingly enough, has tripled in size in the last probably 8 years. It was a really small kind of micro market. It was born out of necessity when the downtown was so tight and tenants couldn't find opportunities to lease space downtown. They went over to the east side, smaller buildings typically over there, 75, 50, 50,000 to 110 is kind of the max over there.
Kind of cooler, hipper, younger.
Exactly right. So Hines has a mass timber product called T3, which they've done in a lot of other locations. So that actually has been pretty successful.
And that's a good walkable area, right? You're behind the Whole Foods.
There's a lot of your bars, restaurant, nightlife, and all that has really kind of spurred that growth. Now, what's happened subsequently is that submarket again has tripled in the last handful of years, and people developed. In the meantime, market crashed. All of a sudden, downtown is 30% vacant. Those people that might have looked into the east side might say, well, listen, I'd kind of rather be downtown. There's a little bit closer to where I want to be, easier to access in and out. And so there's plenty of opportunities downtown. And do I really need or want to go to the east side?
What's the delta between the price to lease downtown versus in East Austin?
A Class A office tower downtown is going to be in the brand new Republic that Lincoln's doing is in the mid 50s to low 50s, indeed, in a couple other buildings. So call that 52ish. East side 42, and that's brand new. You're still having the same concessions. You're still given a year free. You're still given $150, $160 in TI to finish out these spaces, but you're getting those rates. But downtown, you're also paying a higher OpEx number. So in Austin, we're a triple net market, which means we've got a base rate of, in this instance, $50 a foot or $52 a foot. And then you have an operating expense number, which call it $25 to $30 a foot. So that's a gross number. Then you add parking on top of that. When you get over to the east side, property taxes are less on the east side than they are in downtown. So that OpEx number is reduced. So while there's probably a $10 a foot delta in base rate, when you get parking plus the OpEx number, it's probably closer to about a $15 to $16 a foot delta between those two.
Is that enough to lure people over to the east side?
It hasn't proven to be. And I think, again, a lot of it is because you have a lot of brand new product on the east side, and it's hard for those groups to do anything less than 7 to 10 years. The economics just don't make sense, right? When you're giving $150, $160 a foot, a 5-year deal, you lose money on that. So you've got to get longer term. Not everyone can have has the capacity within their business or operations to sign up for 7, 10 plus years. And so when you have fewer second generation spaces on that east side, when you've got plenty downtown, you can go do 3, 4, 5, 6 year deal in any building downtown for the most part, where it's harder to get done in a brand new building.
So where do occupancy rates need to get to downtown in order for these other markets to start to see? Some people say I can't do downtown anymore. Yeah,
good question. I think that when you've got a market that's at about 30% vacant, right, the only spaces that are going to lease are the really good spaces, right? And so, for example, we've got some buildings where we have lower floor space that doesn't have great views. We're not spending our effort and time there, right? If someone's going to come look at 20,000 or 5,000 square feet, they're going to look at dozens of options, or they have dozens of options. And so for them to look, they're only going to look at the things that really make sense, that kind of check all their boxes. And so they're not going to come and lease a lower floor that's got crappy views because they've got 7 other options that are, in this building that have better views. So, I think as the quality top tier space gets taken downtown, then that kind of flows out. And then there's also just kind of, again, the price sensitivity to it as well. And it's a different vibe and feel for however you want, either downtown or east. They each have kind of their pros and cons. And there's been some pretty good velocity of leasing on the east side as of just late, the last probably 2 quarters or so. But I'd say, I think last time I looked, the market's at maybe 52% occupied. So it's probably struggling. It's also the youngest, if you will, of any of our submarkets, but it's struggling the most in terms of just overall occupancy.
Yeah, so I live in East Austin, and there's a building going up on 7th and Pedernales. Are you familiar with that one? I was told that it was all pre-leased. So it's mixed use. It's going to be 4 or 5 stories. I think the folks who are behind it are build design, and I think they're bringing in engineers and architects. Yeah. But I was very surprised to see that thing move forward. I think it's encouraging for East Austin.
Sure.
And I think for the right type of tenant, East Austin is cool and interesting. But I hear you loud and clear. There's some companies that say, well, I couldn't afford downtown, but now I can. I want to be downtown.
And there's, I think, depending on your culture and your employee base, right? I mean, it's, if you've got kind of that young millennial or even younger, employee base, that east side's great. And it's a lot more affordable to live there than it is in downtown.
That's right.
Or within a closer proximity to that area. So, there's a lot of reasons that make sense. It will be interesting to see, right, City of Austin's TxDOT and I guess not Cap Metro. I guess TxDOT, right, is going to go through the big overhaul of I-35, which will really run through that whole area. It bifurcates currently right now, east and west of downtown and the east submarket, and it'll be interesting to see what effect that has when that construction starts, because we all know that's going to be...
It's going to be a nightmare.
You're going to be living that all the time. And I think, they'll work through it, but it'll be interesting to see from a demand standpoint, really what impact that has. We're sitting out right here at 316 Westlake Drive. We've got a major road construction project going on. Has been going on for a year and a half. Will go on for another year and a half at least, or maybe it's going on for 2 years. It kind of all runs together, doesn't it? And we're seeing the effects of that on leasing, right? That it's just a challenge when people get here and they're just seeing the road construction. You can get caught up behind trucks. And, again, in a market that has so much availability, someone might just not even worth going over there, not even consider it. I've got 6 other options that are closer to my target or my bullseye. Let's go focus there.
That's right. So that's a great kind of overview of the challenges of the various markets. For somebody who's seen a bunch of cycles, been doing this for 2 decades plus, how have you had to change, how has HPI had to change our approach to leasing office space?
Yeah, I mean, I'd say probably the biggest variable, the biggest change that we've had to make, and I'd say just kind of market wide in this environment versus financial crisis, even in the tech bust, is that landlords are having to spend considerable dollars to make deals. And that's upfront. That's whether that's a super high TI package with a lot of concessions, but a lot of it is really doing spec suites. It seems like everyone's talking about it, but everyone's doing it. If you don't have space that's ready to go, again, there's so many different options for folks to choose and select from. We're working with all of our clients, and some are more agreeable than others, but to spend upfront dollars, and you might go and spend $100 a foot on a space and get a 5-year deal. Well, typically you're not going to give $100 a foot to a 5-year tenant. That just didn't make sense. But if you can design it from our standpoint, we know what it looks like. We know that it's a generic fit. And in 5 years, if we don't retain that tenant, maybe we carpet and paint, spend $10, and then we're moving on down the road. It's already proven to be a good functional space. So the outlay of capital that landlords have to put forward to be successful in leasing is more than we've ever seen. In today's market, those that aren't willing to put up those dollars in one way or another, you don't have to spec out everything, but at least have design plans and good visuals and test fits done for vacancy. If you're not willing to spend that, you're not going to lease your space. And some folks, they've got a loan coming up in a year and a half, and it's not worth them to spend a bunch of dollars in that regard. But that's probably been our biggest shift, is not only knowing what it's going to take and understanding what those costs look like, convincing our clients that that's really the only way that we're going to get activity on the space.
So clients really, or owners, investors really have to manage their properties now.
Yeah.
It's not just like we've got space available, come to us.
Sure, right? I mean, listen, going back 2018, 2019, if we missed a deal, ho-hum. I mean, listen, we tried to make all the deals we could, but a lot of times if we missed a deal, we might get a deal 5 months later and get another $1 increase in rent just because where the market was going. So, it's definitely not like that. Every deal's challenging. Every deal is a lot of work and a lot of effort. And financially, we've all worked on deals that at the end of the day, we just say, listen, we've got to put up our hands. We can't, this deal doesn't make sense for us. Like, I get that it works for you. We can't, between the concessions, the TI, downtime, whatever, it just doesn't make sense.
Are you seeing fewer young people come into the business now because of where we are in the cycle?
I don't know that I've seen fewer young people. I know 3 or 4 people that have left.
Right.
Either left Austin or just left the industry in general. And that'll happen in any downturn for sure, no matter what industry you're in. But it's a good question. I don't know if I would know whether or not people are more hesitant. We've got a group of interns coming in this summer. We'll see what they think.
Exactly. See if they ask for a full-time job or just say, I will stamp my book out my college credit.
We did have an intern 2 years ago who is now has a job as an analyst at one of the good firms here in town. So you got to, listen, in any business or industry, you got to work hard. And this one, you can't sit back and be complacent on anything. You got to really bust your ass, and that's the only thing that's going to allow you to survive. And then you got to go even further to even separate yourself from the rest of the pack.
This is when we're all earning our money now.
Yeah.
This is where we are in the cycle.
Right.
But I also think for anybody who's involved in investments or real estate, it separates kind of the men from the boys. There's no kind of putting your feet up, waiting for the deals to come to you. And it's a good time to be a tenant.
Yeah, it's a good time to be a tenant. And I think, it's interesting in an up market, right, everyone's got the same goal. Everyone's just, long-term lease, good credit tenant, low TI, high rate. Like, everyone's striving for the same thing. In a down market, everyone still wants to make deals, but can you make deals? Does your loan allow you to make deals? Do you, it's what's your clients, what's the owner's long-term plan, right? I mean, is it, do you have the ability to be patient and wait for deals, or do you need cash flow more than you need long-term standard, stabilized WALT? And I'm willing to do a 20%, 30% below market deal to get cash flow and get someone in the building. So you really, I kind of like it in a downturn, although it's extremely challenging for everyone, and the financial upside is very limited. But you spend a lot more time working and talking with your clients, which I appreciate, and you really get to know them and know what's driving and pushing them. And a lot of people have 3 or 4 people above them. They're getting pressure from above to do certain things, and we've got some individual clients and owners that every TI check hurts them. Whether it does or not, they make it feel like it hurts them. And so it's a good time to learn. It's a good time to. You spend a lot of time with your clients because you got to try to convince them that this is the right thing to do, and that you may not see another deal. You get the space back, you might sit on it for 2 years.
Right. But any time a market is going through tough times, that's when you solidify your relationships, right? Yeah. And I think the people who can lean into that really deepen the connection they have with their clients. Yeah, and I think, right, I mean, knock on wood, in a couple of years, we kind of come out and we're on the other side of this, and you kind of look back and say, man, I can't believe we had to do those deals, and man, we just got lucky by the skin of our teeth to get that deal done, or, we missed out on that one, and look, we sat on that space for 4 years, that sort of deal. What do you think the market looks like in 24 to 36 months? Any guess there?
Yeah, I mean, I think we're definitely seeing more velocity. We've had the first 2 back-to-back quarters of positive absorption. Not a lot, but still positive absorption. So
after how many quarters of negative or flat?
Oh, geez, I'd
say going back to 20.
Yeah. I think there was maybe one quarter positive absorption in 21, I think, or maybe early 22.
But essentially 4 or 5 years of
exactly of flat or zero, really, for the most part, or negative, really, I should say. I think, again, with some of the investment dollars that we're seeing spent on companies here in Austin, I think from an investment side, we're kind of going to kind of continue to see that. It'll be interesting to see who kind of fills these big blocks of space, right, where there's is there going to be XYZ fill in the blank tech company, a Twitter, whomever. Are we going to have someone that's going to come in and say, I need 500,000 square feet, and all of a sudden downtown goes from 30% to vacant to 20%, more manageable, whatever that may be, and who's that going to be. I also think that most of the companies that sign leases over 25, most people sign an average lease of about 5 years. So I think people that sign leases in 18, 19, right, those have already rolled. So people have already done their downsize. So I think we're a little bit beyond people making the correction of what their physical real estate is. And they're still going to get some people who are downsizing a little bit here and there, but I think we've kind of gotten through a lot of, hey, I've already made at least 10,000 square feet. Now I know I need 7, so it's a net negative 3,000, but now I can go forward. So I think we're through a bulk of those leases where people have given back big chunks of space. And if we're not continuing to add to that pile of vacancy, then we can start chipping away at it.
So we've stopped the bleeding, so to speak.
Yeah,
and now we can kind of...
And I think, Austin continues to be... we had a great run from 2014 to 19 or whatever, 5-year span, right? And all the reasons that those companies came to Austin still exist today, right? Culture, cost of living's gone up for sure,
right?
But infrastructure arguably is getting a little bit better.
We've got UT, we've got the seat of government.
Yeah.
We've got Musk and everything he's doing and bringing. Those things haven't changed. The airport will be growing.
Right. Yeah. So all those reasons that Google, Meta, right, Amazon, fill in the blank, right, they all came and established a presence here in Austin, or young startups coming here in Austin. All that still exists today. So I'm bullish on Austin, always have been, and I think that those characteristics that made Austin, top of the market in terms of leading with, setting record paces and leases signed, whatever. I mean, just all of that I think is still there. It's just we got to get all this underlying, challenges and question marks in our mind kind of out of the way a little bit.
Do you think cost of living becomes a deal breaker at some point?
It does for, I would say, like the big relocations, like a corporate relocation. I mean, if someone's hiring someone from, the West Coast and you're bringing 2 or 3 employees over, that's not that big a deal. If you're looking to bring hundreds of employees here, then it definitely comes an impact. And if you see, right, I mean, all of that rooftop growth, Cedar Park, Leander, all that far northwest stuff, is way more affordable than anything else up close. But it's great. You got the Domain, which is kind of there downtown, and so there is definitely challenges with affordability. There is access as you get further away. But I think that the cost of living will have an impact if you're looking at a major kind of relocation or corporate HQ move or something to that effect.
When inflation finally gets under control, it's going to be interesting to see where cities like Austin, Nashville, some of these kind of high growth cities where things settle. Yeah, just as somebody who used to live in New York, lived in Nashville for a little bit. Austin is an expensive place to live, right? Just going out to dinner and just living your life. Yeah. And I think for some companies that might impact a move. I mean, I hope that's not the case, but I can understand where that might slow it down a little bit. Yeah. All right, so this is the opportunity for you to put a little free advertising together for your group and for HPI. Yeah. What differentiates HPI? What do we do differently for our tenants, for our buildings? What's the vibe like here? You've been here for a long time. Just why do you like HPI, and where do we go an extra mile for some of our buildings or our clients or our tenants? Yeah, I think probably the first response is just homegrown here in Austin. I mean, there's nothing that makes me more proud to say, we're Austin based. And by the way, we're the largest property management company, in Austin. We set the record on, top industrial broker, Austin broker, tenant rep guys. So we're playing in the same pool as all the big, CB, the JLLs, Cushmans and all that stuff, but we're local. Right. And that to me is a differentiator, right? I mean, that probably means sometimes I don't get business because someone said, oh, I've got to, I need to get a CB, or I need to get a national, a global presence, and that's fine. I think our work stands up for itself for certain. But I think Austin, born and raised, and Brandon and Austin, all the different themes that we've had here really resonate. I think with a lot of people, and I think that's something I'm definitely proud of, and to watch and to see
how we've grown as a company, headcount wise and square footage wise, and getting, when I started, it was office and industrial, right? And now we've got our self-storage platform. We've got the multi-platform. We've got, done the senior housing stuff. So in that regard, that makes us, more than just a, kind of two-show pony, right? We've got a lot more to offer. And from an investor standpoint, I think that's really interesting. I think we get a lot more, visits and eyeballs on HPI because we can pitch a number of different platforms to folks where, 10, 15 years ago, we didn't, we weren't really playing in those different sandboxes, and now we are. The other thing too is just because HPI has owned and own and operate a good portion of our real estate, office and industrial. We say it all the time, but it's kind of born into our ethos is that, we act like owners because we are owners. And so, again, when we're having these tough conversations with whether it be big institutional investors or, individual private, investors, I know exactly, like, I wouldn't recommend you spend these dollars if I didn't think if we owned it, we would spend these dollars, right? And here's why I would do this deal, and here's why I wouldn't do this deal, right? And so, I think, again, we're not in the business to do transactions. We're in the business to create value, and I don't know that everyone else can probably honestly say that. And again, I'm invested, like all of us are invested in these buildings. We know what it's like. We got capital calls. We understand what each deal does or doesn't do to the overall, health, longevity of the building. And so taking that same mentality across every one of our ownerships, whether again it's HPI or our third party, we just don't know any different. We just we act as though we own it, or we come from a mindset of an ownership mentality and mindset. Yeah, and I wouldn't recommend my client do something I don't think that we would do if we own the building.
That's right. And to your point, we own office, we own industrial, we build and own multifamily storage. We've done 40 some odd deals throughout the country. Yeah. So we walk the walk and we talk the talk. Yeah. Definitely not a transactional shop, and I think that makes a big difference.
Yeah, and I'd also really say that our our close connection with our management company, I think, is pretty unique. I know that not all firms from a leasing and management really are all that tight, and I think between our management and leasing team, we work really well together, and that gives a really cohesive, culture. And it helps from our client perspective, right? When we're all on the same page and, we're on one call together with our client, we've got management, leasing, all working in tandem. And that doesn't always happen with every other shop. And I think our management team brings a lot of value to us, and it makes it easier for us to do our job and to shine, to be personally, to be honest, because they're the management and engineers and guys that are on the ground. They're the ones that take care of the day-to-day operations, right? And as long as we're not giving them a basket of coat hangers and it's a total mess, they're pretty nice to us.
I agree. I think our building guys and ladies do a really good job of keeping tenants happy and allowing you and guys like you and me to focus on some other things. Yeah,
the other thing I think I'd say as well is that, we're also developers too. So we own stuff, we've built stuff. So we know what it's looked like. We know we're tracking interest rates, tracking development costs, looking at land costs. Like all of that is what we take into our daily operations of leasing office space. While it may not come, into conversation, but we're always out there trying to figure out what's the best deal for acquisition, a development, leasing, and having that kind of full-rounded view, if you will, of kind of really every aspect, right? Full cycle of office, whether from ground up, development to acquisition to leasing to disposition. Like we play a role, our team plays a role in all of that. And I think that's something that not every team gets to be part of, right? They might have a development arm over here and maybe just a leasing team handles that. But, we kind of get the full cycle of that. And again, it just gives us a little bit different perspective.
Yeah, well, I think it's a true 360 perspective. Yeah. And you're not expected to be an expert on everything, but you've got guys who sit 5 feet away from you or 10 feet away from you that you can pull into a meeting or a call or just kind of say, hey, Davis, that kind of thing. Yeah. All right, last question for you. Again, thank you for I don't think I thanked you at the beginning, so thanks for sitting down. I think this is awesome. You obviously work hard. What do you do for play? How do you blow off steam after going through some of the stress that your role requires?
Well, It kind of depends on season, if you will. So right now, I literally just got back from a trip in Colorado to go ski. So that's one of my outdoor passions. Being and spending time outdoors is probably what gets me, motivated the most. Whether that's hacking away, I'm terrible at golf, but
right.
4 hours sitting out in the sun, running around with some buddies, I don't mind that at all. I still stay pretty active from a running standpoint, and trying to get into swimming. I absolutely hate swimming, but I'm going to try to get into swimming this year as I'm not getting older, and the joints will get less mobile down the way.
I was out in Arizona last week, and we spent the weekend at a buddy's place in Scottsdale, and I swam for the first time in a while. I was like, why don't I do this more often?
I know.
My shoulders like, oh.
It's way better for everything than me out there pounding the pavement and running the trail and stuff. But it's been out time. I've got 2 teenage boys. I love spending time with them. I've got one about to go off to college, so it's literally like almost every
Tulane.
Yeah, going to Tulane. Green
roll wave.
That's right, roll wave. So it's interesting to really think about almost each day. Like, all right, is this going to be the last time we're going to do this? While he's living at home.
Right.
Family's obviously super important. So
it's hard to balance, but it sounds like you work at it.
Yeah, that's part of it. And the team here and the folks I work with here are fantastic. And it's, I think one thing to say also about HPI is just the longevity of the tenure of the employees here, right? I mean, I've been here, again, over 2 decades. JD and my team's been here for over 10 years. Sam, came out of the womb.
95, right?
95, right? Chris has been here for a couple of years. And, if I just look around, the office, looking at people that I've known for 15 years plus is, there's a lot of them.
Well,
sticking around.
Think about the photos you see of Richard, Kent, and Dick.
Yeah.
And they're all in their 30s.
Yeah.
They've been doing this for quite a while.
Yeah. Yeah.
Well, great. Richard, thank you very much for taking the time to sit down and talk with me. I've been talking with Richard Paddock, one of the office partners here at HPI.
Yeah.
This is the 3rd in our HPI CRE conversation podcast, and hopefully you enjoyed it, and we'll be doing some more of these. So
let's do it again. Appreciate it,
Richard.
Thanks, Rich.